Chips getting checked today. Shares of Taiwan Semi dropping more than 2% after the company said it is seeing signs of slowing demand for smartphones and PCs. Meantime, AMD dropping more than 8% after getting a downgrade over at Barclays, the firm citing risks to its PC and gaming market in 2023. Is this pull forward, Dan?
Well, maybe. I mean, the fact that we're still talking about lockdowns now we're in Q2 of 2022 is pretty shocking. You look at a company like Taiwan Semiconductor. They came into this year in January. They had raised their sales guidance. They had announced that they were going to maybe spend up to $44 billion in CapEx. Apple is a 25% customer of this chip maker here, and so you have to think about what are the reverberations here. And so, this company's going to report in a couple of weeks. So, again, do they have to do they miss that guidance that they just gave? Do they guide down for Q2? These are the sorts of things that should be kind of weighing on the broader market. A stock like this is down 30% from its recent highs, but look at the SMH and the rally it just had. This is one of the largest components there. So I think the major indices or some of these ETFs where stocks like this are large components have not caught up yet.
And then longer term, I mean, if you think about the political risks involved to Taiwan Semi and others, BK, if there is a move to reshoring and that actually sticks, that could benefit the chip industry here if that gets underway and the political tensions with China continue.
Yeah, and I think we're going to see that. I mean, I'm old enough to remember when there was actually a chip shortage, because that was last year. So I can still remember that. And it's funny how we've kind of flipped here. But also remember, chips are very cyclical. So this may be an early warning sign about what's going on in the economy. Like we said, we already know China is contracting. So are we starting to see the early signs of economic slowdown globally? And are the chips the canary in the coal mine? I think you need to pay attention to it at the very least.
I mean, so you're hearing it from chips, sofas, RH, crop tops with H&M, Pete. I mean, the list is starting to grow and it's going across industries here as the show goes on.
I got to the crop top part of it threw me off a little bit, but yeah, no, I get I get what you're saying. And you know what? When you listen to RH, they talked about how the pricing is going to have to go higher. And so when you start hearing that, do they have the same kind of pricing power that there are in other types of businesses? I don't think so. So because of that, yeah, I think that this is something that we all have to make sure that we are paying close attention to this whole thing, Mel, because this is something that is going to get worse before it gets better.
Bonwin, give me a trade on a chip maker.
Long term, I actually like the Intel story for all the reasons that you just mentioned in terms of domestic production, ramping up foundry ability and manufacturing ability. Looking at AMD and Taiwan Semi today, I actually tend to want to rotate to a name like NVIDIA. And I know the multiple makes you want to shake your head and take a second look. But being that they have some specialized situation there in terms of gaming, and that's being viewed as an alternative to other streaming services and other consumption, I can at least wrap my mind around why that might be something that's sticky and actually has room for growth there.
All right, let's get another check on how markets ended today. The Dow dropping 550 points, all three indices falling more than 1.5%, putting in their worst quarter in 2 years. And the two-year yield topping the 10-year rate moments ago. Inversion. The I word. The move comes as Fed officials seem to be less confident the U.S. can avoid a recession. Let's bring in CNBC senior economics reporter Steve Liesman. What are you finding chatting with all those Fed folks out there, Steve?
They're obviously not predicting recession. What's really interesting to me, Melissa, is they're not strictly ruling it out. And I think that comes from two sources. The first is that there's a lot of unknowns out there. They don't really know how to process what's happening now with the Ukraine war, the extent to which vital commodities are both up in price and may even not be available. When you look at what's going on with Putin and the idea of making the Europeans pay for natural gas in rubles, it's an interesting bit of brinksmanship going on right there. The other sources, they don't quite know how they're going to get inflation under control using their two tools of balance sheet reduction and interest rates, how much pressure they're going to have to give on the economy. So, look, they say, the economy's in good shape. We'll probably get a decent jobs number tomorrow, and that the economy can take interest rate hikes. But it's really a question of 2023. Will there have to be a slowdown? Will there have to be a decline or a flattening of growth in order to really get inflation under control caused by the Fed raising rates above neutral to really tamp down on the economy?
You know what's so interesting, Dan, is that when we talk to strategists and folks that track the markets, 2023 is generally, if they are forecasting any chance of recession, it is in 2023.
Yeah.
And that's what Steve is talking about.
Yeah, and I think Steve would defer to us on the stock market. The stock market would probably discount it by the time we have that recession, especially if it's one that's actually orchestrated by design, as BK has been saying. I mean, that's really what the Fed has to do. They have to slow things down to some degree. And, I just don't believe that a 15% peak to trough decline in the S&P 500 in one quarter, well before they even started raising rates, is going to be it. That's going to be it. And so the probability of a recession, of course, it increases. It doesn't mean that it has to be attached to a bear market at the time that we actually officially know the recession is here.
Yeah, and Steve, I got to ask you how Fed officials are thinking about the inversion of the yield curve. And I know that we make a big deal out of it. It's happening as we speak right now. The yield curve is, in fact, inverted. It's a moment of time. We'll see how long this persists. But whether or not that is a contributing factor.
Write it down. According to my data, I look at the tick data, it was 4:42 and 10 seconds was the moment that the curve actually inverted. A bit of a false alarm a few days ago when it actually got to zero. But yeah, it really inverted minus 0.1, minus 0.2 at 4:42 this afternoon in the after hours. And as I've said before, Melissa, the Fed likes to look at more of a near-term curve. It likes to look at the 3 month to 2 years, sometimes 3 months to 10 years. It's more interested in the information given by the markets over the time period that they're trying to forecast. There's also some economic analysis that shows those near-term curves do a better job of predicting growth and forecasting growth. But they're going to look at the 210. They know what the record is of the 210 predicting recessions. They're also going to look at a variety of different spreads that are out there. The investment grade, non-investment grade spread strategy, look at mortgages to see what's happening to financial conditions. That's their big interest in the fixed income market. How much restraint is being exercised on the economy on the one hand, and then of course they're concerned about whether or not balance sheet reduction and those sorts of things creates dislocation in the market, such as they're going to have to ease up and are going too fast.
All right, Steve, always good to see you. Thank you. Steve Liesman. Brian Kelly, I'm going to ask you this question, and it's going to sound flip on my part maybe, but do you care what Fed officials see in terms of recession? Because they got the inflation part of things wrong. And I don't mean any disrespect to Fed. It's very difficult to forecast. Let's put that out there. I don't forecast.
Yeah.
so it's easy for me to criticize.
Exactly. Well, as Yogi Berra says, predictions are hard, especially when they're about the future. However, I would say that the Fed has a huge credibility problem. It was less than a fortnight ago that Powell was on TV and he said, hey, listen, I think the odds of a soft landing are pretty good. Now, all of a sudden, this story leaks out that maybe they're going to be looking for a recession. JP Morgan had a report out today that Bank of England might need a recession. So clearly there was an email that went around and said, hey, listen, we need to start preparing the ground for the potential of a recession here. My view is that's exactly what they want. You cannot fight the Fed in this environment, which is what makes me a lot more cautious in this environment. They do not want asset prices to rip higher. They don't want the economy to rip higher. They need things to slow down. In my book, that's a recession, and in my book, that's coming.